All right, we're at the hour. Check, check, radio check. Want to thank everybody for taking time out of their busy schedules to listen to us. It's Thursday's Chat with Chris. I'll be your presenter today. So today's topic, I thought about something that, in the past, it's been a while since I've talked about, investment strategies specifically. And next week, we're going to do our monthly recap, which is a rear view mirror a review of what the markets have been telling us, both on equities and on the income portfolios. But there is an element of finances and investments that is part of our overall structure and infrastructure. But sometimes I think people don't fully understand risk and or reward. So when I use the term covered call strategies, you're going to see me here talk about it. I'm going to break it down, but I want to sort of, as a precursor to the next few slides, investments, as we're looking at, and this is typically applied to equities, involves risk, right? But if you're going to partake in cover calls, there's what they call options. And I'm going to get into what that means. I am by no means suggesting in any way, shape, or form that you should run out and consider options. That is not the purpose of this call. I started and looked at option trading very early in my career, and I lost money because I didn't realize that there were professionals out there sniping people that didn't know what they were doing. So as I got made aware, I understand what they are, how they work, but I also make sure that if they're going to be used, in my opinion, there's a safer way to use and implement strategies. And then there's riskier ways, and risk and reward or risk and loss. Okay, so without further ado, I just wanted to sort of precursor, that's my CYA, because I just want to absolutely emphasize, I am by no means saying that somebody should open up accounts to trade options. All right, so what are call options, right? There's two types of options. There's calls and there's puts. This is not a training on options in general. I'm only going to talk about call options right now. So call option contracts are financial derivatives, right? They give a buyer the right, but not the obligation to purchase a security at a predetermined price called the strike price. Conversely, the seller of an option must sell the security at that strike price if the buyer chooses to exercise the option. And then options do not create value, but merely transfer value from one party to another. They can be used for a variety of different strategies, such as making leverage bets on securities, managing risk, and where I tend to focus, sometimes generating income. And then the price of the option paid by the buyer, otherwise known as the premium, is influenced by the strike price, level of volatility, and the option's time to expiration, and the price of the underlying asset. This is why so many people get confused. People that are studying for their investment licenses. This is the area of finances that typically will test most people's metals as to their level of understanding. So what is a covered call strategy? A covered call strategy is an option-based income strategy that seeks to collect the income from selling options while also mitigating the risk of writing a call option. Again, very convoluted language. You tend to, your eyes go back and forth as you start to think about it. A covered call consists of an investor, so that we're going to call this John, owning a stock, and that stock that he owns, and I'm going to hold up in a second here, a stock, and then selling a call option on that stock. So I think a picture is worth 1,000 words. And when I had my office, what I used to do is I would say, okay, if the couple was sitting there as I was trying to explain options in general, I'll say, do you all understand what a stock is. And I'm going to hit stop share for a second, just so everybody can see. So do we all understand what a stock is? And I would wait until I heard the answer I was looking for. And yes, a stock makes you what in a company? It makes you an owner. When you transfer and buy that stock for $100, John traded that $100 for a certificate that says he is now a part owner of that company. I'm not going to get into valuation today. What I want you to understand from this point, John can lose all of this, right? He put in $100, the risk of a business owner buying this stock and becoming a business owner means that you paid $100, sky's the limit, but you could absolutely lose all your money. So that's an important distinction about the next part. So as I continue, let's hit share. Anna thinks that the stock that John currently owns is going to rise above $105 and hence decides to purchase a call option. That means John owns the stock and he wants to hold the stock. And this is where that term call, because I want you to think about this. Anna, if that stock goes above 105, let's say to 108, 110, 115, Anna now has a contract with John that he must sell that stock to Anna. She can call that stock away from Anna. So now Anna purchases the call option. So I'm going to go back to stop share. So the stock was $100. I got $3 here. Anna says, I want the upside potential without putting in all the capital. So I'm going to give John and enter into a separate contract, $3. This is called premium. That $3, John now gets to take as income or revenue or to be his protection on the downside. He paid $100. That technically, if the stock went below 97, he would, or stayed at 97, he would still be even because he collected the premium and the stock value went down. But at some point in the future, right, there's going to be an opportunity for Anna to make a decision. So let's see what could happen. So potential outcomes, this is the column to the left, right over here, right? Stock XYZ prices rises above 105. It stays exactly at 105 or falls below 105 because that was the contract that was written. John takes on price risk should the option value move against him, but earns a steady income stream in the outcome. So John has an obligation if on stock XYZ rising above 105. So like in my example, let's say it went to 110. John has the obligation to sell that stock to Anna at 105, even though the fair market value of that stock is 110. And he collected $3. So he lost that upward potential from his 103 to the 110. So he gave up, that's the lost opportunity cost of $8. Now, if it stayed the same, John earned the $3 regardless of Anna's decision. And he now took for his stock, it's still valued at 105. She can call it, she can not call it. He owns the stock. And remember, if she does call it and turn around and say, hey, give me the stock at 105, he can immediately go back out to the marketplace and buy it for himself and replace his inventory. And then stock XYZ, if it falls below 105, let's say it went to it never got above 105, only stayed at 102, 104, 98, 99. John pocketed that $3. And that's why I think of, from an income play, this is something that some investments that we look at and strategize with, it could be an option. So this is John's, why John would do something like this. Now, Anna is basically able to benefit from upside with that, or potentially the maximum she could lose in my example is $3. I mean, if that expires worthless, let's say it never goes above 105, at some point in time that stock is worthless and she lost her money. But if it does go 105 to 110, she made $5 on her $3 investment, right? Not a bad return. if Anna's ambivalent, if the stock stays at 105, she paid the $3, it's going to, basically she could forego the option. And then Anna has no reason, if it falls, is low, she has no reason to turn around and pull it away, John, for 105. So again, it wasn't a profitable investment for her. So I wanted to go through those basics so that you understood. And now the term covered comes from the fact that the stock increases. The option can be in the money, which is a negative for the option seller. But because the seller also owns the underlying stock, the gains on the equity position offset the losses of the option. Again, it's just very confusing language. I hope that I did a better job earlier on explaining this picture so that I don't have to get into the weeds there. And but another way to look at this is that the investor forfeits the upside potential for their stock position. So if I'm John and I say, hey, I own this stock, it's part of my portfolio, I want a little bit of extra premium to generate income so I could hold on to the stock, and it's going to go up and it's going to go down. But if it does go on a tear, right, that he would give up anything above 105. That's the risk for him, but he collected $3 premium. But remember, once he sells that stock, he can immediately go back out to the marketplace and look to rebuy that stock as well and replenish his inventory. A short call, a bearish option strategy, which obligates the call seller to sell a security to the call buyer at the strike price if the call is exercised. Again, this was not designed to be an advanced options trading course. I just wanted you to understand that it involves risk. But if done correctly, there are strategies that we can use that can help people generate some income for their portfolios. So why include a cover call strategy in your portfolio? Cover call strategies inherently forfeit the upside in exchange for current income. And remember, you'll hear me talk about probably till I'm blue in the face or till I'm 6 feet under. Retirement is about income. It's about income. It's about income. So everything, when we're talking about it, that we're always thinking about how much do we have coming in, and then what are our expenses, right? And whatever's left over is discretionary. When we can generate, income, and in this case, passive income, cover call strategies provide income-driven investors with a means to which to increase the yield of their existing portfolios while diversifying away from some of the market risk that is typically inherent to the traditional income-generating securities. They offer an opportunity to benefit from rising levels of volatility that might otherwise have a negative impact on bonds and dividend-paying stocks. This is if, we're using a strategy, this is the strategy I tend to lean towards. It's not for everybody. We have to, we have conversations. Tactical is where you're gambling, in my opinion. I think you're rolling the dice. If that's how you're wired, we're probably not a fit, right? But there are many, many people and bets are made every day, right? On where they think, commodities or stocks, equities, bonds, any of that stuff is going to go. So, but why include it is because a cover call strategy, and this my slides didn't work. I was trying to, let's see if I can go back to that. Oh, there it did. Yep. So the bull market, an investor will likely underperform the market as they keep the option premium. So if you own the stock and hold the stock, but you then entered into a separate contract where somebody could call it away, well, then think about it. Logically means if the stock goes up, you're not going to experience some of those gains, and the person that paid the $3 would. In a flat market, the investor will likely outperform as the markets go nowhere, but the investor keeps the premium. And that's why I said in sideways channels, or where the volatility, and we'll see that, is going across, this is where sometimes we can actually get a yield where otherwise there might not have been. And then the bear market, right? That's when the market goes down. It is a safety net for people so that if their stock holdings go down a little bit, they've created some income, to help offset some of that volatility. So the investor will likely outperform as they keep the premium received from selling the call option, which offsets some of the stock's decline as mentioned. So what are these distinguished cover call approaches? So there's either underlying investments, coverage percentage, or moneyness of the options. So underlying investments, more volatility securities can generate greater premiums, but have greater downside risk. So the underlying investment is going to be doing all of this, but you have more volatility. Or you can have a coverage percentage. If somebody takes 100% of their portfolio and then maximizes the premium income, but they forfeit the upside, right? That's how I was talking about it. But if they only said maybe half the stocks in their portfolio, they only collected on half the premium, it doesn't have to be all or nothing. And then lastly, moneyness of the option. So the further out the money, the call options are written, the greater upside potential, but the lower the premiums. They're out the money, at the money, in the money. So again, this was not designed to be an options trading course. It's just to help you to understand that options are risky. Options, you can, like I said, in the first example, so are equities, so is all investing, right? As I was talking about, we could, as a stockholder, if I buy a stock, I could lose 100% of it. That's what businesses face every day in America, is as a business owner or a stockholder, you're a part owner of a corporation, you could experience losses of the business. That's why you get the better than average return on investment. But if you're somebody in Anna's case, the maximum you could lose in strategies, and there are people that specialize, and that's all they do. They buy options, they sell options, they write covered calls, they write covered puts, right? So with that, they could potentially lose whatever the premium is that they paid, and that's their risk. So you have to understand that this stuff is confusing. It is not for the faint of heart. I would go so far as to say this is probably for accredited investors. However, like I said, with a good financial advisor that can take the time to say, this should not replace anybody's entire portfolio. But there are strategies. I typically will use ETFs, which we've talked about before, to be able to use an index where potentially somebody owns, the index, which you don't actually own, and then you're collecting a covered call in the index, helps to collect the premium on the underlying basket of stocks within. So again, I just find it's a less risky way to be able to get some yield without actually, exposing ourselves to an abundance of risk. So this is one of the people that they generated all these slides, Global X. This is their disclosures. There's a lot here. But, diversification does not ensure a profit nor guarantee a loss. You have to understand this is risky, which is why I'm taking a second to make sure you have a time to read it, maybe take a snapshot of it. We're going to take this video and place it. But if you are thinking about and saying, hey, I want to generate some type of income portfolio for my retirement, Chris, what would you suggest? That's when we need to get together and look at your specifics. I've also, in the last couple of weeks, have talked about a couple of things, a no obligation wealth span report or a no obligation Social Security report. As you're heading into retirement and you're thinking about it and you're saying, hey, let's design a custom tailored plan for you. Knowing things like what's your life expectancy. I know it's not typically, nobody wants to know, but there's technology now that we talked about last week with AI that can start to forecast, based on facial recognition, your height, your weight, some of the medication you're on. And then Social Security, right? That as we approach Social Security, right? Should we be delaying it? Should we collect now? Are we going to lose some of it because we're still working, or maybe we're, will some of it be taxed at an exorbitant amount because we're also simultaneously withdrawing from our IRA? All these things are complex, right? So that's what we can do. We can help you to sit on the same side of the table to take a look at what you're doing and come up with strategies so that, you should always be able to understand what you're doing and why we're doing it. What is the goal? Plan with the end in mind. All these things are why, is what makes professional planning services, I think, a value add, and it's what we built our reputation on. So without any further ado, this is the last of it. Hopefully that wasn't too torturous for yourself. Don't keep me a secret. And this is our disclosures.